Hello, everyone. Welcome to Wall Street for Main Street podcast. My name is Mo Daoud, and today's special guest is Charles Ortel. He's the managing partner of Newport Value Partners. He's also a contributor to TheStreet.com and Washington Times. Charles, thank you for joining us.
Thanks for having me on.
Now, Charles, we just passed the 5-year anniversary of the financial crisis, and we had all of these problems with the large corporations, with GE and GM, doing crazy financial stuff, and then the banks were, I think some of them were levered over 40 to 1, and they were doing all these kinds of crazy derivatives bets. Has anything really changed in terms of these companies operating more prudently in the 5 years? Have any lessons been learned?
Well, I think it's interesting. I write about each of those companies, and let's take them in turn. I think in the case of General Electric, the problems that our firm foresaw and discussed as early as August 2007, where GE's aggregate level of debt in the finance business was way, way too high in relation to a skimpy equity balance, where they were playing games with their reported tax rates. Some of those things have changed. But unfortunately, what they've done, in our view, is they've sold off a lot of assets. They've basically been in a leveraged liquidation. And when we continue, as we continue to do on a regular basis, to look at and prize out the financial statements, or the pro forma financial statements for the non-finance business, what we see is a non-finance business that, while theoretically strong in some areas, in an aggregate sense, in a cold money sense, is not putting a cold hard cash, free cash flow, per every dollar of revenue on the board. So we see a declining revenue picture in GE. We still see a finance business whose arguably its tangible common equity, the metric against which most finance firms are valued, the big ones, is high, but the profit margins are skimpy. And we think the positioning of the broader enterprise, the finance enterprise, versus the toughest competitors out there, the hedge funds, versus the fleet banks that have slimmed down since the 2008-9 period. We don't think that General Electric Capital, admittedly with some exceptions, we don't think they have the first call on human capital for the finance business. So we think that's a challenged business. And actually, just turning for a second to General Motors, we've done this year. I've published I think 5 or 6 articles in the Washington Times explaining my argument why I believe, first and foremost, that General Motors was not actually restructured the way it needed to be inside the United States of America. Yes, there were changes made, but the fundamental structural headwinds that this company faces in manufacturing cars and trucks inside the United States, from unionized plants that have difficult state laws in which to work around, that really hasn't changed much. The intractable union position that they have, yes, they got some concessions, but they still have militant unions in the United States and outside the United States that once this company returns to profitability will expect payback. Furthermore, General Motors, unlike Toyota, primarily serves the subprime customer in the United States, and that is a sector that remains under even more pressure in 2013 than it was 2008-9. Now, those are relatively minor company-specific issues, but clouding the picture even further is what's happened since January 1st, 2009 to the present. On June 25th this year in The Street, I wrote an article called "Prepare for a New Banking Regime." And in that article, which I'd encourage your listeners to go check out, I cite some statistics that you can verify by going on the Federal Reserve website. And what you see is that the Fed has simultaneously been pushing interest rates, both at the very short overnight end and the 10-year end, right down on the floor, pushing up all these assets, allowing people with access to credit and allowing manufacturers to disguise the true cost of things like cars and engines and other things that GE sells. In this very low interest rate environment, that has had the biggest prop to reported signs of progress since January 1st, 2009. But along the way, what's happened is you cited banks that were over-leveraged, and I'm guessing you meant Lehman. The Federal Reserve's financial statements as of the most recent, in quotes, audit that they put out, are more stretched, the way I look at it, than Lehman's were back in 2008. So, yes, people have been fast and furiously engaging in all sorts of corporate finance maneuvers and government programs and this and that. But when you cut through it all, as our firm likes to do, we see the global financial economy right now more exposed today than it was in 2008, 2009, because in addition to those problems, we face massive geopolitical headwinds that have been, catching fire in the last really 12 to 18 months.
And what I see from the GM side, and it's not just GM, it's the entire auto industry, especially here in the United States, is they're just trying to force credit back into the system. And I think the largest growing credit market, or one of, besides student loans, which I think is also a bubble, is the subprime auto loan market. That credit has just been exploding again in the last 18 months, where you can get an auto loan now, almost no money down, 10 years, and you don't have to make payments, I think, for the first couple years. So it's really insane. It just looks to me like they built too many cars with the subsidized materials that you were talking about with the cheap capital, and now they're just trying to dump the inventory to someone else so they can book, their inflated earnings, and the people at the top of the company can collect those stock options.
Yeah, I mean, it's almost, if at first you don't succeed, fail again. I mean, the problem, I think, in GM's case, and why we locked onto it, is that when the president and the Democrat Party made their 2012, the essence of the 2012 campaign, Al-Qaeda is, Osama's dead, so Al-Qaeda's on the run, and General Motors is alive, right then you knew that powerful forces wanted to make sure that the GM story looked like it was a good story, and perhaps rules were bent. Now, if this were a different day, where you had a real and emboldened SEC and an empowered Department of Justice determined to protect widows and orphans, you'd be taking a very hard look at the GM case, an excruciatingly hard look at the GM case. Why did the unions get rewarded the way they got rewarded, not having to take the kind of haircuts they would have had to take pre-2009 in this bankruptcy?
And sorry to interrupt you, Charles. And the bondholders, correct me if I'm wrong, the bondholders for GM, like these pension funds, I believe Indiana State Teachers Pension Fund, they got totally screwed, right? Whereas the unions ended up taking over the equity that the bondholders should have taken, right?
Exactly. And then when it's interesting that the SEC has done a number of interesting things that are good for investors, one of which is you're able to get correspondence readily between the company and the SEC. It's publicly disclosed, and there's a lot of interesting correspondence in the 2008 forward period involving General Motors. So here you have a case where the taxpayers were and remain at risk, and so we owned all these securities. Then it became necessary to exit, the government to sell these securities to the public. You remember the Facebook case, where in their IPO, people got all high and mighty over the fact that venture capitalists were selling out in the IPO. Where are those same voices taking a hard look at, exactly when did General Motors sell? I mean, did the government sell? What was the true condition of General Motors, let's say, in the campaign period, as the government was unloading shares, and after then, as they were unloading shares to try to make the case to the American public that it was a good deal? Curiously, I don't know how well you know the GM case, but for the first 3 quarters of 2012, there was no massive write-down of intangible assets and offsetting write-down of other things. But just after the election was won, a decision was made sometime between the time they released their third quarter report and the time they released their full year results to take a gigantic write-down. And one wonders, what was the discussion like? Did they delay that until after the election? Anyway, there are very few auto analysts that go in depth through these issues. Not only, you mentioned the point about the subprime customer, the reality is that GM sells primarily in the car and vehicle market direct to dealers, so they control a lot of sway over, who takes delivery of what. They can book sales in a way that a typical company can't do it. And then for a large piece of their business, they sell to the auto leasing companies. And take a look at HTZ, which is Hertz, and CAR, which I think is Budget, or it's some other large one. And those companies are challenged as well.
And this is why we call GM Government Motors now.
Exactly.
Yeah.
So, and in addition to you, before the 2008 crisis, you warned your clients about GE. Another company that I found surprised that you warned people about was Berkshire Hathaway, which is owned by, obviously, Warren Buffett. And you're warning people about Berkshire Hathaway. And after I was thinking about it for a while, it kind of makes sense because back before the 2008 crisis, Berkshire Hathaway did have a lot of exposure to the big banks such as Wells Fargo. And so I just wanted to get your thoughts on why do you think Berkshire Hathaway was troubling to you? And also, if you look at all the companies that are out there today, which one do you think are headed in the same path or in the same predicament as companies like GE and Lehman, where they could be in big trouble very soon if the economy doesn't improve?
Okay, well, let's take the case of Berkshire first. I mean, I'm having run for many years a merger and acquisition department, putting together diversifying acquisitions for people, admittedly 20 years ago. I developed a feeling that in the more modern market era, that astute investors can put together conglomerates far more effectively and at lower cost themselves in the market using ETFs, however they want to do it, without paying the type of control premiums that you have to pay to do these big acquisitions, as Buffett seems to like to do. When I initially uncovered the problems at GE, I thought to myself, what are the other companies out there that are similar to GE? And that's when I, immediately thought of Berkshire. I took a hard look through their numbers. What I discovered is that when you can do this for yourselves, when you look at the period, I think it's 65 is when he has this long time series of how he actually did, that I find a bit misleading. He trumpets the return on equity that the company delivered from an accounting standpoint, which is different in a year-to-year period as how his stock price may have moved. But even so, when you take his numbers and you look at the period, say, 65 to 98, the results are fantastic for that period. But for 98, 99 forward, they really are not very good. And, in the period 65 to 98, 99, there weren't that many hedge funds and activist investors out there against which Buffett had to compete. But in 98, 99 forward, a very different story. So I didn't like the performance disconnect in those two periods. I don't like the basic construct of the company, so heavily involved in finance and then dabbling in these various industrial plays. I don't like the thesis. I don't like the way in which he made the investment in GE and in some of these other companies. Having done this myself for a while on a much smaller scale, but as an advisor for some big people, it's very, very risky to do, just 48-hour decision making on large deals. And then further, when Buffett made comments as he has made, he's made some very contradictory comments. He called derivatives financial weapons of mass destruction, yet he held, and I think still holds, a large derivatives position.
He sold a $5 billion worth of puts, right, and collected that much in premiums, right?
Right. But I mean, they're either financial weapons of mass destruction that no one should play with, and I don't agree with that actually. Or they are, and I don't see how you say one thing to the public and do it.
Well, his actions have been exactly, Charles, and I think the point you're making in a roundabout way is that he's a hypocrite because he's telling the public, not to play with derivatives, and then here he is playing with the largest ones, right? So, yeah, he's not eating his own cooking. It's just really funny like that, and you got to wonder with his political connections then, because not only is he a hypocrite, he's also a crony capitalist. If he knew that the banks were going to get bailed out, with the Goldman Sachs, if they were going to get their money from AIG first, so that's why he put the money in, or with GE and things like that.
Yeah, there's another one. I mean, the investigative journalists have a lot of work to do, and I think they're going to go back over this ground, especially after we go through the next phase of the crash, which I think is coming, and it could come very soon. But one thing to look at is the timeline on AIG, GE, Goldman Sachs, and Buffett, and take a hard look at the finite risk reinsurance investigation that the SEC had against many players all at the same time. I don't know what the ultimate resolution, I haven't looked recently at it, of that investigation was. But what troubled me, I happened actually to go on television for the first time in business stuff on September 16th, 2008 on Bloomberg. And with Tim Fox, that's when I warned about GE, and I said it wasn't, in my view, as strong as everybody thought. Things quickly went my way, and I think that next week or so I was back on with Tim, and he said, well, you got that one right. What else don't you like? And I said, well, I don't really like Berkshire Hathaway all that much. Went through that, and the following week I was scheduled on again, and I happened to go on the day that they announced that Buffett was investing in GE. But he really didn't invest in GE the way the other people, the common shareholders, the people who bought GE common shares. He got a special deal, which was held out to the retail public. You should buy common shares in GE because Buffett is buying preferred shares and warrants. And that's the kind of transaction I don't like to see. I think that's a wrong thing to do. You should make very plain to the retail public, that if Buffett is doing this because he's getting a heavily promoted, much better deal with a, greatly reduced downside, and as it turns out, a much higher upside, then you need to make that plain to the moms and pops who put the money up at that moment of great stress way back then. So I think that in time will grow to become a textbook case of how you should not rescue a company.
And I believe also he made a sweetheart deal with Goldman Sachs as well.
Yeah, he did that actually right the week before.
Yep. And so I just wanted to get your thought on the second question that I asked, is there any companies now that you think are in the same predicament as GE or Berkshire Hathaway, where they could be in a lot of trouble very quickly with the economy going downward?
Yeah, I mean, the way I would look at it is that the real action and the real trouble is going to come from because of the dollar, because of interest rates, and again, because of geopolitical currents. From 1965, as I point out in the article I mentioned earlier in the street, 1965 to 1999, the average rate on 10-year treasuries, according to Federal Reserve information, was about 7.5% nominal. Now, inflation was low in 65, and then it spiked in 81 or so, but it was still, and then it came back down. But real interest rates inside the United States at a moment in time where we were, in a conflict, a Cold War with Russia, at a time when China and India, were basically hopeless back in '65, and Europe was still socialist. In that time frame, interest rates were 7.5% on the 10-year risk-free rate, which is, as you know, the benchmark for pricing securities, and then the overnight rate averaged in that period, using their data, 90% of the 10-year rate, which means that, if you're a well-connected, wealthy person, you couldn't really avail yourselves of too much, in quotes, benefit from doing the duration mismatch trade, where you borrow overnight at a low rate to capture this, much higher yield premium for the extra term structure of the interest rate. In contrast to that, tough set of headwinds, in the period January 1st to whenever I wrote that article in June of 2013, the average interest rate, I think, on the 10-year then was in the 2 and change area, and from January 1st, 2009 through June of 2013, but the effective interest rate overnight was 5% of the 10-year rate, which means there was a massive gain to be gotten if you thought you had to get the high sign as to what might happen to the 10-year rate. So you borrow overnight, you leverage up a position, you hold these much higher yielding 10-year treasuries, and you think you're a genius until you get hit by a tsunami. And that tsunami is coming because when you look at the Federal Reserve financial statements, you look at the central bank financial statements, the World Bank, the Bank for International Settlements, what you see is at one operating convention, these banks do not mark to market. And so in the period January 1, 2009 to present, what has happened to the various 10-year pieces of paper that the Fed has bought? Well, interest rates dropped, but now they're on the rise. So what's the mark-to-market loss on the Fed's financial statements if the Fed continues to lose control over that benchmark rate? And who's going to plug the gap? I mean, who's going to put the money up to bring the Fed's skimpy capital structure into where it needs to be? I wrote an article in February in the Washington Times suggesting then that I thought the Fed needed $1 trillion injection of equity, and to prepare for what will happen as we lose control in the West of nominal interest rates. And my guess is actually the United States could do it because the federal government has excess assets, lands. We do, if we were to go and become an investor-friendly country again and stop the war on capitalism, then I think a lot of capital would stay in this country and more would come into it. But so long as we have the gridlock that we have and the messing around that we have and, the huge liabilities and potential for mayhem now being caused by Obamacare and disarray in our geopolitical activities, I mean, that's the biggest threat. It's that, the entity that we're counting on to save the day itself is under stress. And who stands ready to write the big checks to fix that mess?
Now, Charles, I think that's an interesting point you made, especially about the Fed losing control. And you've written articles about the likelihood of sovereign wealth funds and other players creating an alternative to the dominance of the Fed. And add some more color to this for our listeners. What do you expect the future to be like? Do you expect China to create more votes and more power for itself at the IMF and World Bank and, go through the SDRs and reduce the Fed's power that way? Or do you expect China to have the world reserve currency in 10, 15, 20 years? What do you see coming?
I actually see it coming a lot more quickly than that. And I don't speak because I have any inside information, because I never would speak if I had inside information. But, just looking at the balance of probabilities, if you go back to that fateful day, December 31, 1999, what's happened to investors is akin to what an eccentric friend of mine wears a T-shirt that says, and it's an old phrase, the beatings will stop when morale improves. And so for investors, the beatings have been continuous since December 31st, 1999. I mean, very few people in real terms, adjusted for what's happened, forget inflation, adjusted to what's happened to commodities and stores of value since that date. Very few investors in fiat currency securities have achieved a fair risk-adjusted return for their long positions that they may have taken since then. And now we have this place where it must be clear to the world at large that the United States is not going to get serious anytime soon. The soonest would be maybe 2014 November, but reality 2017 January is about as soon as you could count on any real solution that would be investor-friendly in the United States. So if you're sitting there with a whole bunch of dollar-denominated assets or euro-denominated assets or yen-denominated assets and no place to put them, because if you look at most of the Western and Japanese banks, their statistics, the commercial banks, aren't that strong. And then you're sitting there as a sovereign wealth fund, and I think in the most recent article that came out last week in The Street, I gave a list of 8 of them, of their assets off of institutional investor rankings. They have, I think, more than or approaching $3 trillion in liquid assets. It wouldn't take all that much money to set up a new entity, for them, say $250 billion of equity, which I know sounds like a lot of money, but in the context of the global pile of wealth, which is over $200 trillion in assets, it truly isn't. So you set up a new entity, you capitalize it with some sovereign wealth funds, maybe some hedge funds, maybe some of these traditional investors. It has no legacy liabilities, and then you sell assets to the beaten institutional and high net worth public, and you denominate those deposits against a basket of things that would be perhaps tied to price changes in essential commodities, gold, silver, platinum, palladium. There are various ways you could do it. You take the proceeds that investors put in your bank, and you turn around, and unlike the other banks, You say, we're going to go long and short, because there are companies out there, like General Motors as an example, I would argue like GE as an example, and others, that are not going to do well when these interest rates soar back up. So this new entity could be long and short. It could have a serious rating agency attached to it. It could have a strong custodial entity attached to it. And if such a thing happened, a lot would change in the global balance of power. Just now in the news today, we see that Saudi Arabia is incredibly upset with the United States over the recent messing around under Obama with regard to the Middle East and Syria and Iran. And, the Saudis have substantial reserves. What would happen to the market if the Saudis, got behind such a plan? The Chinese have been making very strident noises about this. Russia's been making noises about this. Actually, I mentioned
they've been buying. Sorry to interrupt you, Charles, again, but they've been buying a lot of physical gold too. So they've not just been talking the talk. They've been saying, we don't want to hold as much paper U.S. Treasury or dollar reserves. We're starting to diversify out of those too.
Yeah, physical gold to me is a screaming bargain if you're a long-term investor. You should never. To be. I'm not a trader. Really a trader of any kind. I'm a long-term investor, and sometimes things get way out of whack, and I think the price of gold seems to me, and precious metals seems to be suppressed. So that if you don't have that much of physical precious metals in your portfolio, this is an excellent time to be, adding to those positions. There are very few, in my mind, there are very few equities, and I'm sure there are exceptions, but there are very few equities that seem to me to be screaming buying opportunities now. And when you go back over long periods of time, what you see is that there always are periods where certain asset classes become screaming buys. And so what we're going to see in this correction is a euphoria, and I would argue it's almost an uninformed euphoria, correct abruptly into a place where equities are extremely cheap. So going back to this new entity, if the new entity gets created and has liquidity and decides to be aggressive, it could make money on the short side. It could turn around and snap up bargains on the long side at the end of it. So, if I can see this as just one person, I'm sure that the governments around the world and these very large investors see this, and they see a train wreck coming, not just with Obamacare, but with the whole global economy.
And also, if you look at other trends, the BRIC countries are also talking about creating their own central bank as well.
Yeah, and see, the challenge is that very few of these. There really isn't an existing multilateral financial institution that operates above the level of national regulation. Right? J.P. Morgan, you see them now being taken down by this administration. In some cases, fairly. In other cases, perhaps not fairly. But there isn't anything that sits atop national regulators at this point that is sort of a higher power. But if you could create something, if you could find a legal architecture so that you weren't hostage to, no one's going to put serious money today in Russia, given the recent history. In India, you're not going to do it. The currency is trapped. It's partially converted. In China, who believes the numbers? And you could say that, frankly, about many U.S. numbers, too. I'm not just picking on China. So one would need to find an architecture where you could be certain that that laws would be applied fairly, and that when you put your money into the architecture, you can be sure you can take it out. But I think enough of these parties that have been forced into the dollar, the euro, and the yen, enough of these people have big enough piles of money that that's the biggest threat to the market.
So I have one last question for you. So we talked about all the companies that failed during the crisis and before the crisis, like GE, GM. What about countries that are going to do well during this type of economic environment? Which company or sector do you think is best able to weather the storm that's coming ahead?
Well, if you force me into companies, the discipline that I go through when I look at individual company stocks is I try to figure out the free cash flows that are generated in the home country of the company. So that if it were a GE, as an example, I try to figure out in the industrial side, inside the United States, selling to customers only inside the United States, how is this business doing? And the company doesn't produce those numbers, so you have to do it yourself. You have to guess. But if you guess on a consistent basis, you can get a sense of how they may be doing inside their host country. And then how are they doing elsewhere? And then I try to figure out, for the U.S. risk, what's a fair discount rate to apply to the free cash flows of the U.S. business? And for the international pieces, what's a fair discount rate to apply to those? Going through all that work, how does the calculated result compare to the market price? And for so many of these companies, what you'll see is the calculated result is, a tiny fraction of the market price. So, none of the very big companies that I can think of just off the top of my head rises to the level of something that I'd be taking a hard look at. In the flipping on its side and saying, if we accept that perhaps there might be another crash, and that it might even be worse than 87, or perhaps worse 1987, or worse than 1933, or maybe as bad as 1873 in American terms, where might there be places to put substantial money after the crash? And there I'd be thinking in terms of energy, across the energy sector, because I think the United States, as screwy as we are at the moment, does have substantial technology, experience, and resources in the energy sector that will be exploited come what may in whatever situation we're in. So there've got to be some bargains there. Those types of companies are a little bit easier to value than many. But I would be more thinking right now about the short side than the long side.
Now, Charles, I definitely think I agree with you on the large caps. I'm an analyst for my day job, and I look at a lot of financial statements and also PowerPoint presentations, and I just don't see the revenue growth. The forward PEs are very high. It looks to me like a lot of these large cap companies are they're, like I said, they're not growing their revenues. They're taking advantage of all this cheap debt to buy back their shares, to manufacture, financially engineer higher earnings. And then it looks to me also like these large caps are just a benefactor of this cheap pool of money and credit that the Fed is giving out to like hedge funds and institutions, and then also the flight capital from some of these other countries where, maybe things are worse, like people fleeing Europe, people fleeing England, people fleeing Japan, and they're going into, U.S. real estate, they're going into these large cap dividend stocks. Is that what you also see?
Yeah, I absolutely do see. I mean, I would agree with that. I think there's also another factor that when you go out, as I regularly do, I'm sure you do too, and you talk to not the gigantic investors, but people who have a portfolio, and that sort of the incurious retail investor will say, well, the yield on my money market fund is so low, and if GE blows up again, I'll have bigger problems than that. So why don't I capture the yield that is so much higher than my money market fund on GE and just, close my eyes, hold my nose, and hope, that things will be better on another day. That is, that's not a professional investment approach. That's an amateur, approach, and that's one that is fraught with gigantic danger. Amongst the pros, let's park for a moment the issue of trading day to day, because there are various strategies. In the volatility, you can actually, if you've got the guts and the stomach and the money, you can make money in a very volatile environment, provided you're not forced, provided you have enough liquidity, and you're not in a position where you're hostage to the financial system. But that requires a lot of money. One area that has its risks and is not for the retail investor is credit default swap market. And there, despite the fact that in my judgment, the financial system stands more exposed today than it may have been back in September of 2008. Credit default swap prices, the insurance contract prices, are much lower than they could sort of become if the scenario that I see happening happens. And let me just quickly take that one. We've got a bunch of third quarter earnings announcements that have come out. Companies like GE have announced, but they haven't provided the detailed 10Q quarterly data yet. We're in a moment between now and really March 31, 2014, where I suspect we're going to get a lot of bad news. Management will try to gloss over it, but when you guys and others like you and when we do the type of incisive work that you have to do, you're going to see a very disturbing, contracting revenue trend, shrinking margin trend, shrinking free cash flow trend, mounting contingent liabilities. And then you're going to also be in the moment where the CEOs are going to say, you know what, 2013 has basically been a dud. So why don't we throw the kitchen sink in? Who knows what's going to happen in 2014? Why don't we lay people off? Why don't we take restructuring reserves? I think you're going to have a lot of bad news in the industrial and service part of the economy, particularly as they consider that the hopes for growth in China and India and BRIC places has not been what everyone hoped, that Europe may restructure again. There'll be all these arguments to basically take restructuring reserves. And, no reason to do anything heroic by way of gigantic acquisitions that could lift prices or, big share buybacks with debt. And then, as you started to mention at the very beginning, the banks, the big banks are going to get pummeled by rising nominal interest rates because the credit quality of, the marks for their loans, are going to get hurt. Yes, they may have some trading profit, but the reason to keep your money in some of these thinly capitalized banks, what's that going to be?
And then on top of that, these big banks are also holding, they're able to borrow, and they're holding these assets like real estate and stocks and other things. They're doing all these trades on leverage. So when they're betting on the long side, and then when the price of the assets drops, they still have to pay back the debt. So it's just a really remarkable that it seems to me at least that not many lessons have been learned leverage-wise for these banks. And yes, American banks have been better recapitalized, I would say, than European banks. But that's not really saying that much, especially when these guys continue, to borrow basically almost at zero and leverage up, these trades and play games in the currency markets, the bond market, the stock market. I mean, I learned asset allocation strategies, right, Charles? And the stock market, the bond market, the real estate market, they're not all supposed to go up at once at the same time, right?
Well, but you see, what I argued way back when, I argued that on that fateful weekend of September 13th, 14th, 2008, the global system entered, we died, we failed, we entered purgatory. And since then, we've been wondering whether we're headed up to that nice, fun place, heaven, or whether we're going to start burning in hell. The fact is we don't really know yet. What has kept the whole game going is this illusion that the Fed can forever print. And I know Mark Faber said, I think it was yesterday, that next step will be them doing QE to the tune of $1 trillion a month, which of course is impossible. So I think we're now in to use Obama's phrase, the president's phrase, a teachable moment in finance, where it won't be long before people say, wait a minute, the thing that's holding the entire system up, let's take a hard look at the Fed's financial statements. Exactly how much equity does the Fed have, and what does that mean? Why is it that this supposedly strong entity has never actually been audited? Why do they use financial statements that, conventions that are so aggressive versus the rest of the world? Why do we trust this?
And that's a great point, and also why the balance sheet's so big and continues to climb, which is one of the reasons why they'll never be able to taper and raise interest rate, because then the interest rate on the bond, mortgage, credit card, etc. will explode and go up, and then the government will have to, when they pay back their debt, it's going to be even more expensive for them.
Well, yeah, that's why I wrote the piece in February suggesting there is a way through it. It's like anything else. I mean, if you go into the Federal Reserve's, they have a lot of good data, actually, useful data. One is they keep tabs on capacity utilization in the U.S. And now that's a squishy concept, capacity utilization, right? When you have Moore's Law doubling the power of basic machines and transforming, so many things. Forget that issue. Forget the nuance that maybe their estimates of capacity are understated. Doing it the way they do it shows that inside the United States we're operating at a fraction of rated capacity, which says that we should be taking capacity out of the system. Another point is that when you go back over long periods of time, you see that the amount of capital investment inside this country is basically not that large.
Charles, the Fed's policy is just distorting so much. The price signals with the interest rate manipulation is just distorting and misallocating so much capital and resources and then you add in Obamacare, which you touched on. You add in a possible carbon tax, which could come down the line in a few years, or a value-added sales tax, and most businessmen just don't want to hire full-time. They don't want to make that investment into the real economy, and instead a lot of these guys in the larger companies are just buying back their stock instead, or they're investing outside the United States. So I think that's basically what you said.
Yeah, that's exactly right. I mean, it's put another way, it's just a lot simpler to use technology to use technology to basically engineer people out of the equation. As you see, I do a fair amount of walking around here in Manhattan. You walk by these drugstores, and instead of having checkout clerks now, they have self-checkouts. And these are not expensive people, and even then, companies are engineering them out of the equation. Same in places like McDonald's and other places. So you have, and that's operating not just at the very inexpensive labor price point, but up the chain. You have continued outsourcing, mitigated in part by this geopolitical instability, but you have the threat of that, and then you have this whole immigration thing, where you've got undocumented workers that can be put on the payroll even now, and maybe especially now, and all of this is a threat against these people who've sadly and tragically been out of work since the first Obama election.
And that's a great point. Charles, we'd like to thank you for coming on for Wall Street for Main Street podcast. If people want to find out more about what you do, where can they go?
The best and simplest way to do it is just to Google my name in quotes. So Charles Ortel in quotes, O-R-T-E-L. And as it turns out, there are quite a few videos and interviews and articles and this and that. And my Washington Times address, there are ways to send me messages. I'm reluctant to give my email address out over blindly.
You have your Twitter, though, right? So.
But Twitter is Charles Ortel, and I do my best to try to answer questions and suggestions. And I applaud you too for doing this. I think it's a great thing, and I appreciate the chance for coming on.
Thank you, and hopefully you can come back on in the future.
I'd be delighted.